Okay, so good morning, Stuart. Nice having you
Yeah,
here on the program where we're going to be talking about the work that you've been doing at the Maturity Institute. So I think as an introduction, just tell us and the audience what the Maturity Institute was intended to do, why it was set up, and we'll take it from there.
sure. The Maturity Institute was set up over 10 years ago. It was set up by a group of people from different parts of the world with different backgrounds, and we all shared a common belief, which was that fundamentally organizations weren't realizing the value of the human beings which work with them or was otherwise connected to them. So their whole human systems the potential of their whole human systems wasn't being realized, and there was a lot of value going missing. And on the flip side, we also shared a view that the risk that organizations were carrying with respect to their human organizations or their culture, the human capital, the leadership which comprised their organization, that risk wasn't being captured. So we set out to really quantify the value that an organization can create through its whole human system, and quantify the risk that it would be carrying. But also, and more importantly, we also shared a view that organizations functioned at their very best when they were creating value for all their stakeholders, rather than just creating value for their shareholders, or creating just value in a much narrower frame. So we were really about connecting the human organization to the creation of true underlying, what we now call stakeholder value.
And how effective has this measurement system that you've come up with? So I've read your book. So I know about the OMINDEX with its 32 questions. And what we agreed to do is we said we're going to be speaking about the content over weeks to come. But just as a start, for those who isn't aware of the OMINDEX and the measurements thereof, just briefly give us a synopsis of that and how that application actually works, and what it means for a company if they could understand
Sure.
it.
So again, back 10 years ago, we decided we needed a measurement system that fundamentally could sit alongside conventional or traditional financial analysis. We wanted to show how the health of an organization through a human lens or a human framework could be compared and could sit alongside a traditional perspective looking at profit and loss or balance sheets. But actually what we used was a credit rating. So actually we worked with one of the large credit rating organizations to create a measurement system which could sit alongside and look like a traditional AAA credit rating scale. So ultimately you could see the organization's health, one through financial lens, if you like, through traditional credit rating, but actually what we created was an organizational maturity rating, or what you just indicated, which is our organizational maturity index measurement or rating system. And the reason we did that was to, one, show that how we could quantify the value of the human organization, quantify the value and the risk, but create a common language so that everybody can understand what AAA would mean when we said AAA in terms of organizational maturity, or what investment grade would mean, or what junk grade would mean. And I'll give you a very quick example. When I sat down and presented at the London Stock Exchange in 2015, we talked about a rating that we had produced on Nestle, and the chair of the session said to the whole audience, over 100 investment managers, and said, Stuart's just issued a rating and research note on Nestle, which was 2 notches below junk. And it was fascinating how everybody understood exactly what that meant. it crystallized this notion of culture and human beings and human capital leadership into something which had conveyed a very, very simple meaning. And that's been really important in terms of being able to communicate to chief execs, to finance directors, to investors and other stakeholders. It creates this common language of understanding which had been missing previously.
And out of interest, what was the investment world's rating on Nestle at that time when you of that analysis? How did that compare?
Yeah, I mean at that time it was much higher, and in fact the work we did subsequently, both looking at the banking sector and then working with investors, typically showed quite a large gap between financial ratings and what we now call OMINDEX ratings, and that gap tended to tell us something. So, for example, a lot of the banks which we were regarding as low rating in terms of their organizational maturity had much higher credit ratings, and that gap we identified as kind of a risk ratings gap. Again, Nestle's rating at the time was much, financial ratings were much higher than its OMINDEX rating. Suffice to say, since that time, you know, Nestle has performed okay from a shareholder perspective, but has gone through a number of episodes where activist investors have tried to get involved and accused the company of not managing itself as well as it should have done. Interestingly, when we shared the research note with the investment community in that particular meeting, the panel, and particularly one of the big investors in Nestle who was on the panel with me at the time, agreed with the note. So the investment community were already recognizing the issues of leadership, culture, human capital were incredibly important, and we were able to crystallize and quantify that and demonstrate that this leadership and management quality, which had largely been opinion, could be distilled down into something meaningful, which said something, and that's really informed a lot of our work since in trying to help certainly the investment community understand how much organizational maturity matters to the value of an organization.
It sort of gives you a way to articulate and quantify that gut feel about a company where the investors sort of they know something's off, something doesn't feel right, but this tool just gives you a way to bring it to the surface and actually bring some numbers behind it, that it's not just an opinion.
Correct. And I mean, still today, although we've had a large growth in ESG data or sustainability metrics, the way that investors consider an organization in terms of leadership and culture is still dominated by a subjective sense and a subjective viewpoint in terms of opinion. What we've been able to do is to take, you know, that gut feel or opinion and take them through a methodology which creates a distilled measure, so that when an investor uses a rating or looks at a rating, it can articulate its opinion, but actually show that in using evidence rather than just their gut feel or their opinion. So in that sense, it becomes a much more powerful way of understanding the organization in human terms. And actually the part of our strategy originally through the investment community was to help engage with boards and leaders on this subject. So actually the quality of the engagement that investors have been able to have with their portfolio firms, the firms in which they engage, is that much better. Rather than just take random subjects, they've got a much more coherent understanding of the nature of the organization that they invest in, and their ability to go to the C-suite and have much better conversations about issues of leadership and human capital.
So with all that, so I've got one more question in terms of the how does this OMINDEX rating or the maturity rating sit alongside or on top of the ESG ratings, which is so quite the rage at the moment, and a lot of consulting firms are putting some numbers out there.
Yeah, I think fundamentally it's a different measurement system. The OMINDEX is measuring all the ways in which people or human capital connect to value. So it's a measure of the inputs or systems or drivers of value outcomes. ESG ratings have tended to be an amalgamation of a number of different outcomes or outputs in environmental, social, and governance terms, or ESG terms. So they've been largely buckets of outputs of things which have been put together and largely cobbled together under this banner of ESG. The ESG data providers have tended to focus on the quantity, so the amount of metrics they put into the bucket, not necessarily the coherency with which that bucket of metrics sits together or works. So a good example is the G in ESG is really about organizational leadership. Now that's a very different measurement of environmental performance or environmental risk or environmental outcomes. And when you put the two together, it starts to muddy the waters. So one of the problems of ESG data, which still persists today, is that some providers will rate one company very highly, another provider will rate it very low. There's a lack of consistency and coherence amongst the data providers, in a way that credit ratings, for example, tend to have a much narrower cluster. So credit ratings, because there's a much more consistency around what they're measuring and rating, their ratings tend to be clustered and grouped together quite closely, generally speaking. ESG data can be very, very dispersed. And that's a problem of measurement. And it's led to a situation where, because of that, and also the fact that ESG data isn't really properly reconciled with the performance of the organization in financial terms, it's kind of sits separately. That's allowed people to attack it. So ESG as a construct has been attacked very heavily in the US, for example. And that lack of evidence, that lack of reconciliation between ESG data and the fundamental performance of the organization in value terms has allowed it to be undermined and constantly poked and prodded with accusations that it's just the woke agenda, and it's largely become politicized. So our measurement of understanding value and understanding human value through the lens of maturity has kept it very, very closely tied to understanding that getting maturity right creates higher levels of value financially, but also for all an organization's stakeholders. And that allows us to, has meant that the evidence around that is difficult to attack. We've created a much more compelling and powerful data set around saying mature organizations, one, create good outcomes, but they also create better outcomes for all stakeholders, including shareholders.
So what I like about the approach is that you are measuring whether the company has a plan to do something, what's their mission and vision, or what's their plan around culture, what's their plan around decision making, what's their plan around all these type of different aspects. And then you're also looking whether that plan is implemented. You're also looking whether that implemented plan is bringing the results that you've asked for or intended in the first place. So it's very robust.
Yeah, so we're made so
Would
so
that be a correct summary of the approach?
yeah, we spent a lot of time trying to make it as robust and as rigorous as possible. A lot of time testing the methodology through academia and researchers to make sure we've got the foundation right. So one, we're measuring 32 different elements or factors of maturity, and as you've said, from purpose to decision making to innovation to performance management and learning, values, principles. So a lot of different elements that comprise and causally link people to value. But as you've also just suggested there, it's not about ticking boxes. It's actually about testing the evidence of whether an organization is effective. So one of the downfalls of ESG is that a lot of boxes may get ticked. For example, we may have a great diversity and inclusion policy, or we may have a great policy on mental health and well-being. We've got lots of training activity around XYZ. What maturity does is to recognize the extent of an organization showing some understanding around these issues. But what we're really interested in is the value impact of training, the value impact of a diversity and inclusion initiative or activity, the value impact of focusing on well-being, the value impact of a culture-related program, of the value impact of trying to improve the way it manages human relationships. So ultimately, we're not ticking boxes and taking at face value what an organization says. Maturity is about testing the evidence and the outcomes so that we can look at the effectiveness of how the organization is managing itself. So in that sense, we are testing exactly what you're saying, the organization's ability to implement what it's saying it wants to do.
Yeah, so that's one of those things. It's what drew me to the work of the Maturity Institute in the first place. So tell me about you mentioned that you did, and I saw some of the reports, quite extensive work in the banking sector. And there were some trends that came from that, because I think the real question that everybody has about the OMINDEX and the maturity index is, does it tell us what we thought it's going to tell us? And companies that score well on the index, do they score well financially, operationally, or otherwise? Could you just give us a bit more information on what that work in the banking sector tells us? But I found it quite fascinating when I saw that. But banks, for me, they all should be. They lend money and they people deposit money and they lend it out, and we use it to operate our businesses with. So largely, most businesses models are the same, but the results that was coming from that study was vastly different.
Yeah, so the banking sector was the first large scale sector set of OMINDEX ratings that we created. We originally created a listing in 2017. We updated it a few years later, and we tested it. So the underlying hypothesis is that higher ratings create better financial outcomes and better outcomes in terms of stakeholder or ESG outcomes, if you like. And that whole data set was subjected to some testing at the University of Cambridge Business School, Judge Business School, and they found a really nice relationship between higher bank ratings and higher levels of some financial metrics. I think profitability may have been one, sales may have been another. So there was a relationship between higher ratings and financial performance. But there was also a relationship between higher ratings and better outcomes in terms of ESG risks, so things like misconduct, incidences of fraud, and so on and so forth. So it really did validate our own hypothesis that higher maturity creates better outcomes in terms of financial performance, but also better lower risk outcomes in terms of stakeholders and society. I think just to highlight one of our so out of that study, we found an exemplar banking organisation called Handelsbanken, which was a Swedish bank, and still continues to outperform today. And actually, it's quite rare to find very high-rated organisations. Handelsbanken has been one of those consistently scored well in terms of the rating system. Consistently has been at the top of the financial performance of its within its peer group. But when you look at its performance in a stakeholder perspective, it's really interesting. It tends to be number 1 or 2 in customer service. So its delivery to its customers has been at the high ends. As I said, generally 1 or 2 in all its segments. And it really does deliver on its underlying purpose, which fundamentally, when you look at Handelsbanken as an organization, its purpose is rooted in serving its customers and local communities. That's its starting point. And its philosophy is the better we serve our customers, the better we serve our local communities, the better ultimately we serve society, the greater our ability to perform financially and sustain that performance over a very long period of time. So when you look at an organization like Handelsbanken, it hasn't just performed for a 5 or 10 year period, it's performed over decades. And that performance has been very, very consistent over a very long period of time. And it's done some really interesting things. So a good example, Handelsbanken its maturity is recognized in the sense that it's a very decentralized organization. It trusts people and empowers people within the organization. And actually, it had a CEO that tried to draw back that power and centralize and become more conventionally a more conventionally run organization. It ended up firing that CEO within 12 to 18 months. So it's very, very aware of its own underlying model. It's very, very protective of the special characteristics of the organization, or what we would call mature characteristics, and ensuring that they are protected as a fundamental source of long-term value.
So what I do like of that example is it's not that the OMINDEX is asking you to do things differently, just asking you to do the things that businesses should do, to do them properly and with some forethought. It's not a bolt-on management system, which you do banking for 5 hours and then for 2 hours we're doing maturity stuff. It's looking at the whole organization, and Handelsbanken did this without knowing about maturity. They just are mature. So that's
yeah, that's correct. And I think the point you made is a very, very important one, because maturity in one sense may look quite radical, but actually it's helping organizations largely do what they say they want to do, or they say that they would like to do. So, a good example is most organizations will say that, make claims that people are our greatest asset, right? And that we drive value through our own people, et cetera, et cetera. Fundamentally, what maturity does is to show the organization how far away it is from realizing that aspiration or that statement, and trying to bridge and showing how to bridge the gap between managing the organization largely through a financial lens, through the P&L, through the balance sheet, and integrating how to manage that human organization, how to realize the latent human value that an organization has. So it's really taken an organization down that road of properly integrating itself and realizing that human potential and that human value, not just with its own workforce, but in all its human relationships with customers, suppliers, investors, wider society, and understanding when it builds that organization in that way, it produces enormous amounts of value. And you're absolutely right. There are organizations that have naturally understood that. So Toyota has been a long-term exemplar of the Maturity Institute. We certainly didn't teach Toyota. Toyota understood this post-World War II and have been differentiating themselves for 60, 70 plus years. The point is there are very few organizations that really understand and truly get that. But also what we're able to do is to help organizations that understand that at leadership level and want to pursue that, and to build the coherent set of systems and a corporate culture that can realize ultimately that kind of value and that kind of differentiation in performance.
So there is hope for sorry, Stuart. So there is hope for organizations that are not mature but are interested in becoming mature. Because if I look at that banking sector, there were quite a few firms that stood out at the lower end with operating margins of 15%, comparing that to Handelsbanken's 50%. So that's quite a big financial gap. And does the maturity measurement, does it matter on what the reasons are for doing maturity work? So if we're doing it for, we want to move our operating margin to 20%, up from 15, or is it a chicken and egg story? How if I'm the CEO of a bank or a firm sitting at an operating margin, so let's use the banking example. If I'm sitting at 15%, I want to move it to 20, 25%. What you're suggesting is that working on the maturity should, in the medium to long term, drive my profitability.
Exactly that. And it's taking it's taking what are generally considered as ambiguous or esoteric concepts and showing how there is a causal relationship between those and higher margins. A very simple example. So one of the 32 factors we measure is trust. So we're looking at trust, which is trust in the leadership, in trust in the organization, but we look at trust more widely as well. Generally, higher levels of trust are a good thing. So if people feel trusted, if people feel empowered, but more importantly, if they trust their manager, if they trust their leader, if they trust their organization, that tends to mean that people become more cooperative, they share knowledge, they feel in a safer environment, so they raise their hand, and ultimately they tend to become more innovative, and they tend to give more of themselves in an organization. So taking something like trust and improving it from, say, a 5 out of 10 to a 6 or 7 out of 10 has very, very meaningful results for an organization. And so what we're saying is trust isn't just a good thing because it creates high levels of psychological safety. Trust is a good thing because it creates actions and behaviors which actually drive better results on the bottom line. So if people feel that they can trust their colleagues, trust their managers, trust their organization, ultimately that does get reflected in how they behave at work, how they act at work, how much effort they put in, and that has a direct effect on things like margin, right? And it's getting organizations to understand that relationship and measure that relationship over time, so that an organization can understand exactly where it needs to invest and it needs to spend time to make sure that it maintains or creates much higher levels of maturity, not just overall, but in those individual areas where it can improve and it should improve. So let's flip this around. We're not saying the organization doesn't manage its P&L. We're saying that there's a mutually inclusive benefit by creating an organization where there are high levels of trust, and that goes for better decision making, better communication, better learning, better performance management, creating a more compelling purpose which drives the behaviors and galvanizes the organization. So all these elements combine to drive both financial performance and better outcomes for everybody. So for us, there is a direct relationship between high levels of maturity and things like operating margin, and when we're able to demonstrate that to boards and CEOs, the numbers are very, very big. So to your point, Handelsbanken's margin is incredibly high and has been for a very long period of time. Other banks have much lower levels of operating margin, and that's quite a scary number in the sense that people are often skeptical or uncomfortable with the idea of how big these numbers are, but the reality is they're huge. And I think the other way to look at this is from a risk perspective, right? So we can see not just in banks, but in organizations like Boeing, for example, where we have a much bigger, serious cultural failure, a failure of maturity. The organizations ultimately, in extreme cases, can fail. They can collapse completely and disappear. But actually, what maturity tells us is that these factors don't just drive value, but they also show an organization how much risk it's carrying. And actually, when you look at human risk as opposed to human value, it's often easier to show how much it really does matter, because we can see that line of sight between low levels of maturity and high levels of human risk and really bad outcomes for organizations, and that tends to capture the attention quite quickly.
Yeah, because in Boeing's case, it wasn't some technical R-square value or something on the stock exchange that caused the internal problems. It was humans that caused the problems.
Yeah, very, very much so, and it's well documented now, and we use Boeing as a case study. But the reality within Boeing is that it became such a financially focused organization that it made decisions to remove. It fundamentally lost sight of quality, the fact that it should be producing the highest quality aircraft it possibly can, because they're the safest aircraft. And the reality is that across the whole organization, in lots of different ways, quality was undermined, very simply by not being able, seeing quality managers disappear and not being replaced, by cutting corners around training, cutting corners in how, the actual design of aircraft. I mean, lots and lots of different ways, but fundamentally, human beings acted and behaved in a way which undermined quality to the extent that it wasn't just one isolated case on one aircraft. It's been an endemic problem across multiple different aircrafts. And today, sort of 5-6 years after the catastrophic failure of one aircraft, it's found quality issues, in its manufacturing, which are fundamentally rooted in a human cause, and it's only now starting to recognize how to fix those. And what maturity allows an organization like that to do is to diagnose the problem across the whole system in a way where it can come up with a solution which is multifaceted, and deal with those underlying human risk issues. and fix the ones that can be fixed quickly and but incoherently over a much longer period of time too.
Do we have a maturity assessment on Boeing, or
interesting that we don't, although we do have a couple of online survey responses from Boeing's staff or Boeing managers, and it paints a pretty bleak picture of the organization. So yeah, I mean, that takes us to, while we can measure the organization externally and using our underlying 32-factor methodology, we can also capture the organization's maturity by applying internal diagnostics. And so the evidence we have from Boeing is internal evidence. And as I think, as I remember, broadly speaking, it scored around a D. So from
oh wow,
not an A, it's a D. And actually, when you although it's you can't rely on it, it's such a small, the sample size is not in any way near big enough for us to be hugely confident about the numbers. It's certainly validated and supported what has been said about the organization in the public domain. So that was very interesting for us to be able to just to see that snapshot data.
So on that topic, we haven't actually discussed the nuts and bolts about how do we go about to do a assessment on a company, and does the company have to agree to the assessment? Obviously, with listed companies, the information is all out there. But just take us through the process of how do you come up with a rating on the company?
So there are two primary ways that we can come up with a rating. One is we can do an external rating, and as you've just said, generally for listed firms, there's plenty of evidence for us to be able to interrogate the evidence and create scores across the 32 different factors that we measure and distill that down into a rating. That's what we've been doing since 2015. It's what we did with the banking sector. It's what we've recently done with the legal sector, and what we launched as our law firm maturity index, initially 30 odd, primarily UK-based law firms, where we've produced external ratings. So a look at the organization from the outside in. Interestingly, if we pick up on the legal sector, we've been working with law firms interested in that whole project, and we've been working with law firms to then develop measures of maturity looking inside the organization, so running internal diagnostics, discussions with stakeholders internally, and that gives us both the external perspective and an internal measure of maturity. And when they combine, that gives us a very, very powerful data set, a very, very powerful and compelling measure of maturity. We still get the rating, but it ends up being a combination of the external rating and the internal data, which then gives us a very, very much clearer picture of the organization's maturity, much deeper picture. But for the organization itself and for organizational leadership, that helps them to understand where they can and where they should improve. So we can then help the organization start to build a roadmap for improvement. So what we discussed about just earlier on in the podcast, this idea of understanding how you score against all the different factors, where you should improve, and then how you can make that improvement. And then the third stage, if you like, of the process is then understanding how that improvement then links to the value of your organization. So how does it drive margin? How does it drive better customer service? How does it drive the better top line? How does it lower human risk? How does it improve our organization's ability to perform in an ESG or sustainability context as well. So that gives you a sense of how we're approaching maturity within organizations today.
So there's a lot of work that goes into generating a report. One of the firms that I do know that had a risk rating generated was BP, and maybe we can just close off with that. I think BP, yeah, just tell me the story of British Petroleum.
Yeah, well, I mean, BP.
That's one of the fascinating stories for me.
Yeah, I mean, BP are interesting, really, for lots of different reasons. They were certainly interesting from a maturity perspective around the Gulf of Mexico, the environmental catastrophe and a failure of an oil well, and what was interesting again, fundamentally human causes to an environmental disaster, and that was largely driven by BP focusing on cost within its organization and driving out cost within its organization. What did that long-term cost focus lead to? Well, it led to, again, a bit like Boeing, if you like, the compromising of quality. So, human beings created low quality concrete in the Gulf of Mexico, which broke and caused an environmental disaster in the Gulf of Mexico. So that was really interesting for us, being able to show that line of sight. But BP is also interesting because it's had a history of trying to transition away from fossil fuels towards more renewable energy company, or it's certainly laid claim to that historically. And what so as an organization from a human perspective is, to what extent has BP has really shifted its purpose away from financial performance and fossil fuels to one about truly becoming a more stakeholder, value-oriented organization. I mean, interestingly, we spent almost a whole morning with an investment team considering the energy sector, and we discussed BP at the time because its CEO seemed to be its previous CEO, Bernard Looney, seemed to be authentically trying to shift the organization down and transition the organization to a renewable sort of 21st century focused energy company, as opposed to a traditional oil and gas company. So we spent a lot of time looking at their rating and looking at the authenticity of the organization, but also the capability of the organization in human terms to make that shift. So while a CEO may want to do something, there is often quite significant resistance to change. So how does it go about trying to reshape systems, reshape its culture to make that transition as smooth as possible? Because there's a hell of a lot of jobs, there's a hell of a lot of people that rely on oil and gas still within the BP organization. And trying to make that transition in human and cultural terms is a very, very challenging one. Interestingly, Bernard Looney was essentially fired from the organization for a separate human risk, which was his own misconduct. And since then, it looks like BP have rowed back on where the former CEO was trying to take it. So it's a really interesting case study. But maturity can help us to unpack who that organization is, where it's going, and ultimately act as a leading indicator of an organization's ability to both sustain its present value, the risk that it's carrying to that value, and what may happen to that organization down the line.
So the the knowledge of the maturity of a company is then quite powerful information for all stakeholders of any organization to have. And that's
Yeah, no,
from investors to unions to employees to management.
yeah, absolutely. Regulators too. I mean, we've seen regulatory bodies become extremely interested in issues of culture and human risk. They don't necessarily say it in those terms, but misconduct. Our work in the legal sector, we've seen that the legal regulator in the UK is interested in well-being. It's interested in healthy cultures. So our work talks very directly to that as a stakeholder. But yeah, absolutely. The work that we do, I mean, fundamentally it was designed to help leaders and management teams, improve their organization. But because our work has we can do work externally, it has application to investors. We've done a lot of work in the investment space, helping investors to understand the investments they're making, but also to engage constructively with their portfolio organizations. So yeah, investors, customers, employees, future employees who are particularly future employees who are increasingly trying to make choices around who they work for, not just based on financial success, but based on an organization's purpose and values. That's become increasingly important to attract and retain talent. So yeah, maturity talks to pretty much every stakeholder in slightly different ways.
So in terms of the Maturity Institute, where to from now? Because I mean, the two of us have discussed quite extensively that there's a need for more people to know about the work of the Maturity Institute because of the underlying value that it brings to all stakeholders, not just to companies or investors. And one of the ideas is to do a podcast to explain the work of the Maturity Institute, how it functions, what is the OMINDEX. And over the next few weeks, we're going to be discussing in a lot more detail the different aspects of how maturity indexes are put together. So the idea is, I think the idea is not to train people to become analysts, but it's to understand in depth and create a fundamental understanding and a knowledge of the work that we are doing, because we really believe of the benefit that it can have for society at large.
Yeah, and I think for sure. I mean, certainly we of course have trained many people to understand the methodology so that they can apply and use it in practice. So trained analysts, as you say, but actually our work with organizations and particularly leadership teams and managers, there is a need for them to have at least a more than a surface level of understanding of what maturity is, because fundamentally we are measuring that for them. And the more they understand about maturity, the various elements which make up the diagnostic and the measurement system, the better they understand their own data, the more they understand what the insights they're getting from that data mean, and the better able they are with which to design interventions, design strategies which actually will improve their organization and drive better outcomes, and drive better ultimately improve the value of their business. So yes, I'm very much looking forward to being able to help to unpack maturity across these different factors and delve a little bit deeper to help those organizations and other people interested in the subject to get a little bit more than just surface level understanding about what we do.
Okay. So thanks for your time today, Stuart, and looking forward to taking this conversation with you next week.
Yeah, very much looking forward to it, yeah, unpacking this in a little bit more detail. Thanks very much for your time today.
Great.
It's been a pleasure.
Thanks, Stuart. I'm going to stop the video here. Oh, it didn't record.